Academics who come into ICT, what we naturally do is we study more. And we think the more that we study and the more concepts we know, the better we're going to be as traders. That does not work, and it doesn't apply to the way ICT concepts works, because there is a huge amount of psychology and understanding risk management and stuff that's involved. You could have any strategy in the world. If your risk management and psychology is good, you can make money.
We did a round table the other day. It was like 4 traders, well established, and we all had very different beliefs in the end on like beliefs on risk management, beliefs on how to grow an account. It's not that there was a right or wrong. It was simply down to personal beliefs, risk tolerance, how you are as an individual when it comes to the psychology element. So therefore there's going to be huge deviations just within the population.
People think that there's an ICT strategy. There's no strategy with ICT. This is a concept. It's how the algorithms book price in the market. So when people come to me and say, oh, can you teach me the ICT strategy? There's literally millions of models that you can make with ICT concepts. It's the underpinnings of how the market's actually booked. So this is like algorithmic based price action. What Michael refers to as the algorithm is known as IPDA. It's called the Interbank Price Delivery Algorithm. Now, essentially, this algorithm was created to automate the delivery of price, and it was created by the banks. Money is their commodity, for example, right? They can set the price of that money. Now, obviously, back in the day, there was actual real market makers, what we've been told, and they're pressing buttons and they're setting price. But as technology advanced, it was just so much more efficient to use algorithms like AI and computer programming. Now, the gray area here where people get controversial with it is that
Okay, ladies and gentlemen, welcome back to another episode. Today I'm joined by a friend that I recently met, Ali Khan over here. You know, a joke we have is Alex, his actual name, Spanish name is Alejandro. So Alejandro sounds quite similar to Ali Khan. So whenever he's doing halal things, whenever he's wearing a kandor, we call him Ali Khan. Yeah. So I guess I'm joined by 2 Ali Khans today.
The 2 Ali Khans today in Dubai.
Yeah, how's it going, guys? Yeah, glad to be here, boys. Thanks.
So yeah, I just wanted to give a quick introduction. So I don't think your online presence is too much, and I think that's by design. I think you've tried to keep yourself more in your trading thing, and I think that's why we wanted to bring you on.
Yeah, cool.
You know, the other day we met through Riz. And Riz invited you out, so you joined us, and we had a very cool conversation.
I don't get out much, so I have a 4-year-old to talk to. So talking to the
during the conversation, we went really deep into trading and trading topics. And I remember partway through, I just stood up and shook your hand. I was like, man, this is the first time I met a lot of traders. We've met a lot of traders, but it was the first time I met someone that only talked about charts and only talked about trading and not the fluff around the industry and just psychology or their course or whatever. It was just about charts, and we went deep. So just for that reason, with your depth of knowledge, I think it's a very exciting conversation we're going to have. And I think we want to just jump in for the most of the episode just about trading, which is a special angle we can take, because I know you can talk about it for a long time. Really, so we'll use this opportunity. We had the conversation, but I want to kind of repeat it on camera, especially because Alex wasn't there. Let's talk about, because you're a bit older and you started trading quite late, whereas majority of people start 19, 20 years old. You started in your 30s, I think.
Late 20s.
Late 20s. And predominantly your journey was entirely with ICT.
Yeah, but pretty much, yeah. First year was just retail concepts and stuff like that. And then
okay, so we haven't studied ICT, but of course we know him. Everybody knows him. He's a legend in the game. And the conversation we were having the other day, it really enlightened to me, how much of an impact he's had.
Huge.
He's got a huge YouTube channel. He's very active. He's been around for decades, it looks like. So of course, standing the test of time is something in itself.
Massive.
But I thought, he popularized smart money concepts, whereas you were more reiterating the fact that he was actually more so the creator. And for me, that is amazing. Like, he deserves his flowers, he deserves his credit, because to create something like that, you're an icon.
Yeah, he does. I guess his ego, obviously, he has a huge ego with it, but I guess he deserves it when he's
I've heard about this of like he created it, but because it was just rumors before and he never showed the face.
Yeah, he didn't. He only just recently did.
Exactly. I saw the interview. That's why also I was a bit skeptical of like, I don't know if he was the creator or not, because I never went that in depth as you've been.
I don't know if he's publicly mentioned it. He mentioned it to his, obviously, I'm a private student of his, so in his private group, he said, I coined the term smart money concepts. Okay. So the truth is obviously he created smart money concepts, and this was back in the days during baby pips and stuff where he used to teach on there. And then he drifted away from smart money concepts and ended up with his own mentorship, and then became ICT concepts. But he had only probably taught about 20% of what he knows with smart money concepts. But people went and made their own courses with only 20% of the information and he's still releasing new information, like even after all these years. So in my opinion, smart money concepts was really watered down ICT, even though ICT created it.
Right.
But it was easier for people to repackage it, make courses, and not give the credit to ICT and call it smart money concepts, and we make a course. Realistically, everybody who's trading order blocks or fair value gaps, this is all ICT
Off his
concepts.
shoulders.
Yeah.
You know, I can imagine in his shoes where he's kind of spent his whole career, his whole life on this project, and then you see like kids popping up and doing watered down versions,
100%.
probably teaching it wrong,
100%.
probably, you know, misleading people. Of
The
course, he's
amount
going to
of-
have,
the amount of
plus his character, of
misinformation,
course, he's going to feel some kind of
No,
way.
I understand completely. I mean, the amount of misinformation there is out there as well when it comes to ICT concepts. I personally know people who have been like looking into ICT concepts. They're free like YouTube stuff and creating courses within just 3 months of learning it. Like it's super, super, super hard. Like, and I think a lot of questions that I get asked all the time is like, you know, how did you find your way in ICT concepts? And at first there's so much to consume. And I think people are put off by that because like I come from an academic background anyway. So absorbing a large amount of information for me is quite normal. I don't mind that. But this is ridiculous. Like if you think about everything that he's had on his YouTube, stuff that he's taken, like passed on his YouTube, he's taken down. And his commentary, like he was doing his private mentorship for what, like 6-7 years. And in that time, he would release 2 videos or sometimes 3 videos a week. Each one was around an hour long. That's where the real teachings were.
Was that teaching a strategy or was
No,
that
this is
just market commentary?
So this is the thing. It was, people think that there's an ICT strategy. That there's no strategy with ICT. This is a concept. It's how the algorithms book price in the market, right? So when people come to me and say, "Oh, can you teach me the ICT strategy?" There's literally millions of models that you can make with ICT concepts. It's the underpinnings of how the markets actually book. So this is like algorithmic based price action. Sorry, what was the question again?
No, the question was just if like he was teaching during these 6 years a strategy in these 3 videos he was dropping, or it was more just market commentaries or isolated concepts and then you piece things together.
So isolated concepts, but it was generally market commentary, and that, to be honest, was where the real teaching were, because it was real time and he was pointing where the market is likely to go, but it wasn't just where the market's going to go. There was a why. You see, the market narrative of why price is going to do what price is going to do. There's a narrative what the algorithm works with, and if a price is going to go somewhere, then there's an input and an output, and that's essentially what algorithms are. So he was basically breaking down the market narrative, breaking down order flow of the market, algorithmic order flow, and he was doing this on a weekly basis. But his teaching style is very disjointed. I don't know if you guys have ever heard the story of the Jade Master. He speaks about this all the time. I won't go into the whole, it's quite a long story, but the way he teaches is he makes you work for it. And he said to us many, many times that I'm not going to give you this on a plate. This is years and years and years of my hard work, ICT's hard work. And he says, I'm not just going to put it on a plate for you. If you want to learn this, you're going to realize that this is very, very difficult to do. And he never, ever said to us, this is going to be easy. And he never promised us that you're going to make money from it. And I think I respected that. Do you understand? Because in our industry, it's very, very easy for people to come out and say, look, you know, I can make you money. I can do this, make $100,000 in a day. It's stupid. It doesn't work like that. You know, I got sucked into it when I first came into trading. So,
do you think it's a very effective? I think it's actually a very effective way of teaching, because something that I find is that when people are just given a strategy, they remove all elements of free thinking.
100%, absolutely.
But no real, like a lot of strategies are not just purely objective. They're not fully algorithmic. They need a bit of input from your mind. They need a bit of thought, because not every market condition is the same. So it can always be algorithmic. Obviously, the goal is to create models and trade models to be
100%.
like that. But when you're new to trading, if you're coming in and you know that you're not given a strategy, because this is something we also say to people, is that if you're just given a strategy off our word or off your word, when it comes to you are alone in your bedroom and you're taking a trade, no one looking over your shoulder, you're not going to have any confidence in that. Yes, you might believe that, okay, he told me, but because you don't have true confidence, because you haven't seen it 1,000 times, you're way more likely to deviate, jump in, jump out, re-enter, all of this messy stuff that is also going to lead to a lot of losses. So when it comes to confidence in trading, that is going to come from you created your own plan, you created your own strategy,
100%,
and you tested it. You've seen that certain trade type play out 1,000 times. So what's the difference between 1,000 and 1,001? It's just another day in the game. So when you have that experience and you're kind of given all the tools, and you figure it out yourself, as opposed to this is the strategy, this is the box you're in, this is what works for you. Because we did a round table the other day, and just it was like 4 traders, well established, And the conversations, we all had very different beliefs in the end on like beliefs on risk management, beliefs on how to grow account. And
it's very personal. That's why,
and it's not that there was a right or wrong. It was simply down to personal beliefs, risk tolerance, how you are as an individual when it comes to the psychology element. So therefore, there's going to be huge deviations just within the population.
There is, and I think this is
there's
why
not a one size fits all.
This is why I really like the way Michael taught it, because he always said to us, I'm not going to push you into a mold, because you have to work out who you are first and find out what kind of trading style is going to be basically suited to your individual personality. And like with me, why I feel like I struggled a lot is because, well, I have ADHD. So when it came to like, initially I wanted to be a swing trader, and I was looking at all of Michael's concepts about swing trading and that kind of stuff. But when you're very, very impulsive and your attention span is very small, and you'll probably find in this, I'm all over the place sometimes when I'm talking, but you get to a point where you're like, you try, and it's trial and error. And I realized, okay, swing trading wasn't working for me because I'm pulling up my phone every 2 minutes and I'm looking at the charts, and then I'm changing my mind every 2 minutes. And I realized that, okay, in order for me to understand what kind of trader I'm going to be, I'm going to have to learn everything that there is here and then pick out the things that are going to be suited to me. And this is one of the things that I think a lot of people who come into ICT concepts and they study under him, because there's so much information, they think that they need everything. They don't. I learned everything, and it took me years and years and years to do it. I mean, there's thousands and thousands of hours worth of material to go through. And I was saying to Riz as well that I'm my ICT notes, there's more ICT notes than my own uni degree. So I really, really studied it. But I only use maybe 10% of it in my own trading. But I wouldn't know which 10% to use hadn't I gone through everything, because I needed to match it to my individual character.
Makes sense.
And again, having ADHD, I realized that my attention span is very, very low. So I can only be in the markets for like 2 hours at a time. Do you understand?
Yeah, I'm interested on how did you dissect these concepts on what to pick? Because one of the issues that I had as a trader, or a lot of people have, is that they end up jumping between courses. Which one thing is jumping between courses, but also if ICT has 1,000 things, you could also be jumping between things.
I did that myself.
So between the courses and the concepts, I think it can be a correlation.
Absolutely.
I did a courses one.
Yeah.
This could be a concepts one. Yeah. So how do you manage, or what was your strategy, or how did you do to take certain things? Yes, and
yeah. Well, personally, I think the way ICT taught it, even though I now, after many years, understand why he taught it the way he taught it, and he specifically said that I'm not going to give you this on a plate, so you're going to have to work for it. For me, if I could give advice to people who are coming new into ICT concepts, is really start small and build on a model. Find just a few moving parts out of his concepts, whether you're going to gravitate towards an order block, whether it's a fair value gap, a breaker. Start small, and then you're building a business model around that, right? So if you're naturally drawn towards fair value gaps, you're looking for the fair value gaps, but you're looking for the fair value gap at a specific time of day. This is when you start understanding like algorithmic trading and how the algorithms basically move. You're looking at like previous data points in price that align with time. Without the time, the data points are irrelevant, really. It's when the data points align with time is when there's going to be a macro that's either going to spool price to, say, a fair value gap to rebalance inefficiencies, or it's going to spool towards old highs and old lows to seek liquidity, right? It's very, very basic and simple. Like the algorithm in itself is very basic. It can only really do consolidation, accumulation, a consolidation, expansion, reversal, or retracement, right? So it's very limited. Where that sequence is gonna happen in relation to time is what you're gonna basically work out as yourself as a trader. Like, I'm drawn towards a certain concept, and that's where I would recommend most people start, is find something that, just one thing, whether it's an order block, fair value gap, and build on that. What I did, which now probably in hindsight was the wrong way of doing it, is I was trying to add absolutely everything that I learned into one trading model, and it was just an overload of information. You know, I'm looking, I don't know why I was doing it, but again, it's just myopic in my viewpoint at the time. Was I'm looking at like COT reports on a daily basis. I'm looking at open interest. I'm looking at what the seasonals are doing. I'm looking at, open flow. I'm looking at like every different PD array. Like when I had my charts up, you can't see the candles because I've got from the monthly time frame all the way down to the 1 minute time frame every PD array that's in that sequence. And that's not really what you need. Now I trade completely different from when I first started, but there was a progression and there was a ladder to get to where I've got to now. When I first started, I was looking at just one candle printing up and down and no idea what previous price has done. And just based on that candle going up, I'm buying it. And then the candle's now going down. I'm like, oh shit, let's sell it. Do you understand? So, and when I really started to understand like how algorithms really work and what Michael was trying to get at, that's when I started to look, okay, I see that there's always a turning point around this time of day, right? And when I start finding confluence of like data points from my higher time frame down to my lower time frame, that's going to be where the algorithm is going to reprice and draw towards, especially if there's going to be, say, for example, we're in a bearish climate and on the higher time frame, and there's, say, like equal highs above. Well, we are taught to put our stops above like highs, and when we see equal highs, we're looking at double tops, and that's what I was taught, right? But what's going to be resting above those equal highs?
A lot of liquidity.
A huge pool of buy-side liquidity, isn't it? Now, above that high, there'll be like, say, for example, a fair value gap. And that'll be, say, on like the hourly time frame. And then I'll move to the 4-hour time frame. And on that time frame, there'll be like an order block that overlaps with that same level. So I'm looking at confluences between different data points based on like the higher time frame down to the lower time frame. And then I go from the lower time frame back up to the higher time frame, right? So it's like a top down and then a down top, basically. And in that, I'm now looking at specific levels. My charts are now completely clean, but where I gravitated towards when I say just use one model on one time frame at the beginning, and then work out from that, like the market narrative and market bias. And that's another massive topic that I guess asked all the time.
What does it mean to be an ICT chartered trader specifically?
I think you... As being a chartered trader, being a private student of Michael, the advantage was being able to sit with him in real time as the markets are printing, right? So every week when he was doing his commentary and he's saying, okay, the market's likely to go here, it was the underlying narrative of why the market's likely to go there. And then when you're looking at charts in real time, you've got his voice in your head. And you're looking at, this is the truth. Most of the time when I first started, I was like, bullshit, it's not going to go there. And then when it went there, I was like, shit, it went there. And that's when you're trying to dissect it. Okay, what did he say? Why price is going to go there? Do you understand? You can't get that years down the road when like now everybody gets a hold of his like pirated copies of his private commentary, but sitting with him in real time as he's doing it, and then you've got that information in your head and you think, actually he said this and this is why it's done it. And then you're dissecting the charts and every day you're going back and you're recapping the previous day's price action, which I still do every single day. I recap the price action. When at first it started off where I was doing it, it took me 5 minutes to do a chart. Now it takes me like 2 hours to break down a chart because there's that much. I mean, I cannot like articulate how much information there is in these charts. It's mind blowing. Like after 5 years now of doing this, it's ridiculous.
So it sounds like the most effective route for you to. So chartered is more of a title. It's not like an achievement. It's a group you're within.
No, chartered is when it just being you're with Michael.
Within a membership.
Yeah. So what I've understood, private mentorship for 12 months basically, and then you become chartered at the end of it.
So what I'm gathering is like you can. Let's say I wanted to learn tennis, and I can watch a lot of YouTube videos on tennis. Yeah. And then I'm getting my theory on how to play tennis. So I watch some tutorials. Then the next elevation would be you go out in your back garden and you play some tennis. You test it out of what you learned in your theory. You're playing around. You're working on the hand movement and whatever.
That's exactly.
But then sometimes when you have the reason it's beneficial to have a tennis coach, let's say, is because when you have that coach, and he might be teaching the same thing the YouTube videos taught you, but the difference may be that you're watching him and he doesn't know exactly why he twists his arm like this to the top spin, but you're seeing him do it and you're picking up the unconscious competence.
Yeah, exactly.
And as you said, you got his voice in your head and you're picking it up slowly.
He calls it, he's training your reticular activating system, where you're basically, he's training your eyes. And like what he would do, like a lot of people, I only again found this years after, and I thought, you genius, right, was he would put up like a chart, which now I know is say like a market maker buy model, right? And that's one of ICT concepts. It's basically buy and sell programs. They're the underpinnings of how the markets book, right? And when I didn't realize what a market maker buy model was at the time, there was the first video that I watched and he went on for a rant for about an hour and he's just talking all kind of shit. It's like tinfoil hat talk. And he goes off on a tangent and I can understand, I can relate to it to an extent. But I didn't really get much out of that lecture. It was just like, okay, you know, this guy's seems a bit unstable, right? And when I went back to that same video, like a couple of years later, as he's ranting, he's got the most beautiful market maker buy model on the chart. And what he's doing is inadvertently teaching you without teaching you. He's training your eyes to look at this screen for an hour while he's talking. And you're training your eyes just to see this thing that gets burnt in your vision, doesn't it? It gets buried in your memory. And when I looked at it, I started laughing. I was like, I had no idea, because my viewpoint was so myopic. But it took, and this is again goes back to the story of the Jade Master. The quick version is like, he is the Jade Master, and there's I'm probably not going to tell it perfectly right, but this kid he wants to learn how to read, like know what jade looks like, right? Basically, and jade's like a stone, right? So this kid comes to the Jade Master and says, "Can you teach me to recognize jade?" So the Jade Master, cut a long story short, makes him work for it basically by placing a fake piece of jade in his hand every day, right? Sorry, a real piece of jade in his hand every day. And then he sits him down and just talks to him about all kinds of stuff completely unrelated to jade. And then he makes him sweep his carpet. He makes him do all stupid stuff. You know, Mr. Miyagi stuff, right? And the boy who comes to the Jade Master is getting frustrated, thinking like, I'm not learning anything here, right? And the Jade Master says, look, go back tomorrow, come back again. And he does this for like a while. And as this goes on, the kid becomes more and more and more frustrated. He's like, I ain't learning anything. I'm holding this piece of jade and it's doing nothing for me, but you're not teaching me anything. Just get to the bloody point. And that is with Michael. Mm-hmm. I was like that. Get to the point, bro. Do you know what I mean? He's talking and talking and talking and talking. And then in the story of the Jade Master, eventually one day, the Jade Master throws him a piece of fake jade, and the kid catches it. And the kid turns around and, again, having the conversation. And the kid said, this isn't even real jade. Why have you not given me real jade? And that's when it clicked, when he realized, actually, all this time while he's been talking, I've been training to feel what real jade feels like in my hand. And that is exactly how it was like for me in his mentorship, going through years of it. And it was honestly frustrating. I wanted to quit many, many, many times with it, because especially somebody who has a very low attention span, when you're listening to a conversation for an hour and a half, up to 2 hours of him ranting about certain stuff, but you're not realizing he has 30 years of experience in these markets, and there's so much wisdom. Even he can go off on a tangent, and sometimes it goes a little crazy. But that's just the part, and to be fair, I respect that, because it's very difficult, even coming out here when he has bipolarism, OCD, ADHD, and I don't know if you guys have ever listened to his Twitter Spaces, and this was new to charter students as well, because obviously you have an edit button when you're creating your content, but when you're on live and you see his real weaknesses that he has and like the character flaws that he has, you kind of appreciate that there's a man behind this, and he has real life stuff and real life problems, and you know you can relate. I mean, especially like with the issues I've had, you can relate to that. So I learned to respect the fact that Michael is teaching you in his style, and you have to be patient. There is no way you can learn ICT concepts without being patient. It's going to take you years, and you have to submit to the time. And I think when a lot of people come and ask me, how long did it take? It's completely different. Everybody's...
You know what I find funny is that I've understood and I've heard this comment a lot of, like, I started ICT, but after 1 month, 2 months, I couldn't. Like, and he would go on a parable for 1 hour and lace in a nugget in the middle. So you kind of have to listen to the whole thing.
That nugget changes everything. Exactly. That's a crazy thing.
So what I wanted to say is that it looks like a lot of people are just making careers off the back of learning ICT and just simplifying it and making YouTube videos on that. Do you now, because you've done the full mentorship and you understand it to a high level, the things you're seeing around in the industry of all of these simplified ICT simplified videos, are they doing it justice, or is it completely...
No, one of the things that I get, and this is the reason why I created the ICT Bible, which was like a free ebook that you can get from my Twitter and website, is people are taking his concepts, they're simplifying it, but getting it wrong. Like recently I was like just messing about on TikTok, and somebody had like 600,000 views speaking about a breaker, and completely the wrong candle is being identified as a breaker. So now what's happened is I know that he's taught a lot of stuff, but because it's so complicated and many people aren't just going to sit there and haven't got the capacity to learn, actually sit there and go through like all the process of going through it, they're trying to find the shorthand version of doing it. So, I mean, of course, like the ICT Bible was just to basically make the concepts easier in a format where people can understand it. And that's just in the culmination of 5 years worth of doing all of ICT stuff, going through everything and just piecing all the puzzle together. And that's what ICT really is. It's a huge puzzle. It's a huge puzzle. And this is often the analogy that I use is that it's like, have you ever seen The Matrix? And you've seen, the guy who opens a door and the key and you go to another door. Like that's how it is with ICT concepts, is that you don't know that you have just stumbled upon an ICT gem because you haven't answered the 2 or 3 questions previous to unlock the fact that what you just studied is a gem, right? So it's like opening one door will lead to 2 more doors, and that will lead to 2 more doors. So there's always a question that's being asked of yourself, right?
So that idea of like learning from the primary source and not the people who are trying to simplify it is that yes, you can kind of regurgitate what you've understood from it, but if you're trying to, you can never compete with the guy who created it. And it's something we've faced in the sense of, so I think it's later on in the conversation, we'll do a back and forth of kind of how we trade and how you've learned to trade. Cool, I think that'll be an interesting exercise, but to kind of simplify is, every way of trading has a forefather, and we've learned from people above us. We're standing on the forefathers on their shoulders, and same for ICT. There's people that came before him, but as you go along, you refine and you change and you find your own style. So yes, we have a lot of similarities with ICT because there's elements of smart money within there, but by no means are we smart money purists, and we'll get into what these differences are.
I'm the same.
But we've also noted, because if I compare the trades of ours versus an ICT one, a lot more swing we do. The risk reward is usually a lot higher. Different things, so we can kind of see off the bat that there might be similar inputs, but the outputs are different. But what I find interesting is that we had a very similar thing of people, taking our style and trying to replicate it. And we were doing it to a certain level because we had created it. There was literally points where we're like, okay, this is something interesting. What should we call it? And we sat down, we gave it a name. And now we saw that all over the internet for people selling it for $50 a month kind of thing, which is fine. That's the industry. But what we find worse is that these people would be explaining it wrong, or maybe at points right, but then in the implementation on a chart example, it would be the wrong implementation because they didn't have the true experience, and that will have a trickle effect in the industry because now 100%. It's like a pyramid where the person learned from us, and then he's trying to teach it. So already it's the Chinese whisper effect. He's got some errors within there. And the guy under him, 3 layers down, 4 layers down. There's so many Chinese whispers along the way that they're just so deviated off path.
I make the point to my own students who come to me, learn from the source. I'm there to supplement ICT stuff because I think by now, especially with my own students who come into my mentorship program, they realize, okay, when I say that I've delved into ICT concepts really hard for a long, long time, they can see it because often I get students who come into my mentorship and they're like, it's almost as if it's ICT speaking. And it humbles me. Yes, that's great, but I'm no ICT. Realistically, I recommend to everybody learn from the source. I'm trying to propel you just to give you that, just cut that learning curve. But right now, and by the time this airs, I don't know if it's still going to be the case, but right now ICT is doing his live stuff. And this is absolute gold. Coming from a chartered perspective and somebody who's been with him for a long time, he's got this simplified model, the 2022 mentorship on his YouTube, and it's for free. And to put it into perspective, it took me nearly 3 years to work out that model by all the scraps and bits and pieces all over the place. And like you're saying, when you try to take concepts, all these different things, I came to a conclusion and I made this model. And within 2 videos, he released the whole thing for free, basically, on YouTube. But he said to me, because I had a conversation with him over email, and he said, people are going to be swimming in this stuff. He says, you've trained your eyes for many years under my wing. People don't know how good this is. And it's incredible. That model in itself is crazily good. So what I decided to do, because I kept getting people coming to me, and a lot of it was, like you were saying, misinformation and stuff, and it becomes watered down. And most of the time, what I found doing was just correcting wrong information. People coming to me because they've learned from somebody else who's just watched a few videos on YouTube, made a course, and they just got it wrong. So that, again, why I created the ICT Bible was to supplement that 2022 mentorship. And now I get dozens and dozens of DMs every day by people saying I went through that mentorship, I didn't understand it. Then I used your ICT Bible to just go through get the background on the concepts, and it just absolutely clicked for me. That ICT Bible is just it's to solidify the fact that there's an algorithm in the markets, and any concept, I'm not an ICT purist, despite the fact that I'm a private student of it. I believe that if you can understand like the basics of ICT concepts and the basics of how the algorithms book price in this market, it doesn't matter what strategy that you use to it. Anything.
I want to ask a question regarding that.
Yeah.
So based on your learning curve and piecing things together, did you feel it was more like a whole process, or it was more like you had certain key moments or breakthroughs that actually put you in this position? Do you think it was like a 7-year progress, or it would be more like out of those 7 years, this moment and this moment were crucial in my trading?
I think there were just so many things that you lose count throughout it. Like when I was to put into perspective, like when I first started with ICT concepts and just looking at one candle printing up and down, to now like I have several different charts. I'm assessing the relationship between the bonds, the yields, dollar index. I'm looking for risk off versus risk on environments between the euro, the pound, euro pound in itself, in relation to the dollar index. And then I'm looking at the triad between the three indexes, sisters. So, you know, your S&P 500, Dow, NASDAQ. And I may not be trading any of those markets, but I'm constantly monitoring price fluctuations, and I'm looking at specifically the highs and the lows and how the algorithm is indexing different PD arrays in relation to time and in relation to what the different... See, there's different algorithms that I think book different market. They all essentially do the same things, but they're all communicating with each other. So you can assess from that professional accumulation and professional distribution, like from an institutional standpoint, right? But I would never have looked at any other chart outside of the one time frame and the one, like, say, for example, I used to trade EU predominantly, right? I wouldn't have had any like concept of understanding how the fluctuations in the bond is going to directly cause, but it's going to have a correlation between the dollar index, it's going to have a correlation between the euro, and how the euro and the pound are going to have fluctuations, and how that is going to have an outcome. And if you understand the way I'm speaking, it's if and then and if and then. And that's basically what algorithms are. If this is going to happen, then this is going to be the likely outcome. But there's always a likely outcome because we're still working in that grey area of probabilities, aren't we? What ICT does is, and I think if I had to sum it up, it gives you it makes you aware of the difference in probabilities of any strategy or anything that you're going to do. It will give you, okay, this is a strategy, whether you're using EMAs, whether you're using, Wyckoff, whatever you're using, Elliott waves or whatever it is. It will help solidify, like, number one, your trading model, and it'll make you understand, okay, why is this going to be a higher probability trade versus a lower probability trade? Now, I don't know about you guys, but when I was like doing retail concepts and stuff, that was the one thing I could never understand. My system says buy or my system says sell, but I don't know why. And
that was my main problem. Yeah, so my main problem was curiosity with not having like a true answer for things. That ended up making Waqar, Wally and myself trying to find all of our refinements, all of our stuff, because it was like, if there's no like at least a big reason, even though you cannot know everything, a big reason of things happening, I just couldn't have the confidence to execute.
Yeah, exactly.
Because you give me 5 confluences, but I don't understand the reason behind. Yeah. That's what makes at least me. Yeah.
That is what ICT fixes. Okay. It gives you the reason, and there's nothing else that does this. It gives you the reason behind why price is going to do what it's going to do. That's the huge difference between everything else. Why is it high
Let's actually explain that. How would you understand price movement, algorithmic delivery? What is your understanding on all of that?
Yeah. That's very easier said than done. Explaining it without charts, and I was saying this to Riz when I did the podcast with him, is very difficult. But essentially, what Michael refers to as the algorithm is known as IPDA, right? It's called the Interbank Price Delivery Algorithm. Now, essentially, this algorithm was created to automate the delivery of price, and it was created by the banks, right? Money is their commodity, for example, right? They can set the price of that money, right? Now, obviously, back in the day, there was actual real market makers, we've been told, and they're pressing buttons and they're setting price, right? But as technology advanced, it was just so much more efficient to use algorithms like AI and computer programming, right? Now, the gray area here where people get controversial with it is that I personally now believe, I didn't at first, but now I believe that Michael had a hand in creating this algorithm, right? I don't think he was the only one. I think there was others. And I think with understanding how the financial industry works, in fact, with understanding how every industry works, there is a man behind the man behind the man, right? And, we're not privy to that. We're just normal people, understand? And behind that, there is a level where we don't get to see behind the curtain. I think Michael got to see behind the curtain. And however that happened, what he can do in price and how he can read price and how he can understand this algorithm. And this is coming from somebody who I've studied 5 years and doing this, I've taken it very, very deep. And I believe that I can read price action quite well now. But when I see Michael do some of the things that he can do in markets that I don't want to touch because I know this is going to be a choppy, consolidated market. And you see him, he's pinging up, down, up, down, up, down. And he's calling these levels in real time as it's happening to his private students. What can you say to that? Everybody can come out and say, oh, he's a fraud, he's this, do that. Nobody can. I've never seen anybody do that. And then he tells you why it's going to happen. This is going to happen because of this. And this is going to happen because of this. And if this doesn't happen, this is going to happen instead. And if that doesn't happen, it works out the way he said it's going to happen, you see. So I'm convinced after all these years that, yes, there's an algorithm in the markets, right? Now, how the algorithm books it was a journey where I had to go down this road of like, I didn't just want to take some dude, like his word over the internet. Do you know what I mean? Some guy who's just said, look, there's an algorithm, especially when...
You know when he says there's an algorithm, I'm sure there's hierarchies of the algorithm where you'll have maybe on a central bank level or interbank level.
Yeah, so there's different...
And then you have retail banks who are... Yeah. They're not creating the algorithm, not participating in it. They're not trying to profit from that algorithm. So but there has to be a central...
This is how I look at it. Is like the central bank created this algorithm, right? They set the price, right, through this algorithm. The smaller banks, like Interbank is above your Barclays, your Citibank and stuff like that, right? And them guys are always going to say, no, this is how the banks trade. No, it's not. You're talking at your banks. I'm talking about interbank level, like from the central banks, right? So this is above you guys. You guys have like high frequency algorithms. I understand you have a strategy which you have automated it into a high frequency algorithm. It's smart, don't get me wrong, and they make a lot of money from it. But that's not the algorithm, right? Interbank level traders who sit above the bank, they recognize the footprints of the algorithm. And essentially, this is what Michael is teaching us now. Honestly, it feels too good to know the things that we know. We shouldn't know it. And that's the truth. We shouldn't know. I should not be able to read price the way I can read price. And it's not just me who feels that way. I'm sure there's a lot of other people who've gone through this whole journey to get to where they are now and say, like, this is mad. It actually is madness. Like, I can't articulate just how ridiculous this is. So being armed with this information, I want to clarify that just knowing how the algorithm books doesn't mean you're going to make money. There's a huge difference between trading and being able to read price and understanding how these algorithms book. Yeah. And I think this is where the ICT cult get into it, because they realize, oh, this is the truth. This is how the algorithms book. And it thinks that, and you get this, I think that you get this, like, you think that you've got this power. Do you understand? Like
superiority.
Yeah, I know how it works.
What do you think is that bridge between the ability to trade and the ability to read price? Do you think that's just psychology, or is there more moving parts?
I think mainly for me and my journey, I can say it was down to like understanding, like being self-aware, and working on my own psychology. I went through it, and I believe that it took me longer than most people, to be honest with you. Like when I started with some of my friends who were trading, they were making money, yet I could read price action better than they could. In fact, they would come to me and say, can you clarify this? And I've never been able to not answer a question when it came to ICT, because that's just how bloody hard I studied it. But this is a point. Academics who come into ICT, what we naturally do is we study more. And we think the more that we study and the more concepts we know, the better we're going to be as traders. That does not work, and it doesn't apply to the way ICT concepts works, because there is a huge amount of psychology and understanding risk management and stuff that's involved. So like you could have any strategy in the world. If your risk management and psychology is good, you can make money. Do you understand? So that
when it comes to risk management specifically, what kind of because we have two protocols, for example, where people talk about risk management and it's a huge thing, but it doesn't necessarily have to be a huge thing. For example, we just have two models of how to risk manage. How in depth do you take your risk management?
Do you know what? ICT doesn't talk so much about risk management, right? Because I believe risk management is very personal. It's personal to your risk appetite, isn't it? Like what is going to be high risk for somebody else might be low risk for somebody else. Do you understand? So he teaches us to work that one out for yourself. But what he also really tells us is about taking partials. He says, whatever you're going to do, take partials at logical levels and pay the trader. And then there's a lot of people who find that controversial and say, no, you shouldn't take partials.
It's logical.
I think it's logical. I think that it's better than losing money, isn't it? Like, nobody's ever lost by taking partials. Do you understand? So,
you know what it is? A lot of people are very caught up, and it's a very short-term mindset because they're newer traders. Yeah, when you've been trading for 5 years, as we have, you are not so urgent in the moment. I've got to make a profit today.
Oh yeah,
and maximize.
I was at first.
So what it is basically people are more concerned with maximizing the individual trade. Yeah. Okay, I've got to therefore hold this to its full TP because this is the trade, and usually it comes with over leveraging or they're trying to do an FTMO. This is the trade that's going to pass me. So they kind of mentally, even though they're risk management, mentally they're all in on that trade. Therefore, they have to maximize it. But it's actually a lot more beneficial and profitable if you don't think of a trade by trade basis, rather you think about how to maximize your portfolio. 100%, because I believe the difference is it's a long-term thinking, but it's also different thinking, because if you're thinking on a trade by trade basis, it's logical for you to hold for as long as possible. But you got to realize you have multiple outcomes in the market. One of them is it hits your full TP. So therefore, if it hits your full TP, that hypothetical best scenario is to hold full volume. Okay, that's one variable. But now what are the other moving parts? The other moving parts are you were hoping it was going to hit full volume. It went 80% there and came back to break even.
Exactly.
Okay, so in that scenario, the best thing would have been take partials before, because you were 80%, or not 80% up, but you're 80% there. So you might be 10% up 100%. And back to zero. So what's your loss was zero, you were break even, but your opportunity cost was 8% up.
Yeah, 100%.
So now that is a huge inefficiency in your portfolio,
massively,
because you missed out on that.
Massively.
So now you have to think, okay, on that opportunity where I can take full volume and let's say gain a 10%, how often is that?
Exactly.
And then how often am I doing a break even? And then how often am I losing a trade? So you got to understand, first of all, your portfolio type. Therefore, you got to be very in tune with your win rates, your average risk reward, your profit factor.
You got to collect the data.
Because then you need to understand what is most optimal for you in how you take partials.
Exactly.
Because I do believe you should take partials, obviously, but not everyone should take partials in the same way. Because everyone has different data within their
I don't think very individual. It's very.
And I don't think it's just psychology. Psychology is obviously something.
The risk management.
But I think better than just focusing on I'm a very risk on, risk off, I'm a very this kind of trader. What is better is you kind of be more in tune with yourself, meaning you get better at being present, you get better at controlling your impulse behavior. That is a better psychology control than saying I'm a very impatient person, therefore I should take partial sooner. No, maybe that's not the most relevant conclusion. Because if you know that you're a kind of trader that is very impulsive, therefore take partial sooner, you're feeding into your symptoms. So you have it in medicine, you're a pharmacologist. Rather than treating the symptoms, look at how to get a cure. So rather than getting partials earlier, what you could think is that instead of trying to do that, how about I understand my data and realize the most optimal way for me to take partials would be, okay, at a 1 to 5, I should always take volume off, because every time I've done that, I banked a percentage. And then even if it came back to break even, I still have something on the books that could pay for my next loss. And on the trades where I did go to full volume, that's fine, because I was very rarely hitting a full volume trade anyway to full TP. But the ones that got halfway there, yes, I only took half volume, but those half volumes are the majority of my profit.
Exactly.
If in your portfolio you're up 10% and 9% of that 10% was through partials, then it's not very beneficial to hold full volume.
Saved me so many times. Do you know what I mean?
So what kind of system have you put into place? Is it more psychology framed or more liquidity pools? And is it technical based or psychology based, your partial taking system?
My partial taking system is now it's at logical levels. I've gravitated to an understanding of where I think price is likely to go where it shouldn't go. And this is one of the things, again, with ICT concepts, is when you understand like how the algorithms is going to index premium discount arrays in price, you can see, right, okay, I can see what price has already done. And this is the game changer for me. And I think this is what separates ICT with any other thing, especially when it comes to like risk management and stop loss, especially because I know where price is not likely to go. Do you understand? So if it's not likely to go there, I know like I can place my stop and be comfortable in that position. And then that will allow me to assess the risk going forward. And I can see, okay, if I'm grading this range, I know that based on what price action is previously done, and then looking at what the higher time frame order flow is, I'm likely that, we're in like, we're bearish, right? So the higher time frame is going lower. I know that if I hold this too long, I'm likely for price to reverse and come back on me, because I can see that price is going higher, right? On the lower time frame versus the higher time frame, and the higher time frame order flow is bearish, right? So what I generally do is I'm looking for like that weekly expansion. If that weekly expansion is poised to go lower, then I'm waiting essentially. I'm waiting for the market to move in the opposite direction on the lower time frames, right? So once it takes out, say, buy side liquidity, if we're going lower, right? Then I know that it's already taken that liquidity. And if it runs lower, creates a fair value gap, there's a break in structure, that fair value gap's rebalanced. It's not likely for that algorithm to go back up to those highs again, right? Because we've already the algorithm's done what it needs to do, right? So when I can assess what the algorithm is not likely to do, I can then assess what the algorithm therefore is.
So when you say logical levels, there's obviously a hierarchy within that.
Yeah.
Is the primary, for example, do you believe in market structure, or does ICT use market structure?
Yeah, quite a bit.
Okay, so if you were to label a hierarchy between, let's say, the moving parts of liquidity, market structure, maybe a fair value gap, timing, what would the hierarchy look like?
A lot of it.
And how would you put it into hierarchy?
All of it. You blend all of that. You're blending time first, because like I know that there's time in the day for the price to run like to a logical liquidity pool. If it's not done it by London, it's likely that the New York is going to be a continuation of London, and it hasn't hit a higher time frame data point, right? So I know that price is not likely to reverse yet. Therefore, it will allow me to stay in that trade longer. If we've already hit that higher time frame data point by London, and I'm like, okay, it's a Thursday, I know that from my past experience in collecting data that we may have a Thursday like midweek reversal here, and therefore I'm going to like close positions really. So I'm assessing constantly. If I've got, say, prices coming in my favor, then like I'm reducing my stop now. But now I've seen that the market's likely to reverse, and it's taken out 3 arrays to the high to the upside, and we've had a break in structure here that I could what's the word? I could lose out on profits here. So this is why, again, essentially taking partials is essential. But when I say logical liquidity pools as well, the algorithm is really going to gravitate because it works on these principles of fair value. So when you're grading a range, it's likely to come back into the range after it's taken out either sell side or buy side liquidity. If I see that there's a fair value gap or an inefficiency around equilibrium, I know that, okay, it's going to be better for me to take a partial here. So when I say logical levels, I'm looking at price, like a price point where the algorithm could reverse from here. I'm not saying that it will, but it could. And therefore, if it could, it makes sense for me to take something off here, right? I might take 50% off here, and I leave the rest to run because I've got a conviction that it might aim for that sell side liquidity pool down there, right? The higher time frame order flow is bearish. We've already cleared buy side liquidity. We've rebalanced all the inefficiencies above the market. We've come back to a logical level here. Take something off, right? Because there's no guarantee. It may reverse. But as you develop more experience in this, like you build on that. Do you understand? Like at first it was.
What are the, because when you talk about, let's say, liquidity pools, let's say I've entered a buy. You have so many liquidity pools before it makes a higher high. You could have just, let's say, the last high or low. So you want to target that. Then you could have, let's say, an Asia high. You could have an Asia midline. Then you could have a double top right above it. Then you could have a smart money zone right above that. And then you could have a trend line, and then you have the higher high. So when you have like between, let's say, a 20-30 pip range to make that new higher high that you're looking to make, you could find 5 different liquidity pools along the way.
I'm always keeping an eye on the higher time frame. So that makes it like...
So you're predominantly structure then for your...
It makes it easier for me to like look at the lower time frames, because especially with me, I'm very, very impulsive. I can change my mind very quickly. So if I'm glued to the 1 minute chart, for example...
You'll get lost in the noise.
I'll get lost. I usually take my entries on a 1 minute or 5 minute. I can go down to like the 5 second time frames. I've taken entries on that, but because price is fractal. And again, when you understand how the algorithms work, what you see on the 5 second time frame is exactly what you see on the like daily time frame, right? Essentially, I'm keying my levels really of the daily on the weekly time frame, and that's essential. Anybody who's coming into ICT concepts, I would always say, if you're going to have any levels on your charts, look at the weekly and the daily, because that's your roadmap, right? I'm also looking heavily, and I didn't do this in the beginning because I didn't think it was that important. Now this is huge to my trading, is looking at what the economic calendar is going to do. The economic calendar is the smoke screen. So the news that comes out, they're all smoke screen for the algorithm to do what it's going to do, right? So if I can determine like where the high impact news events are likely to occur during the week, that's going to give me a huge amount of insight to say, okay, whether I want to hold for this position or whether I want to close this position, and is it fitting what the bias and the narrative that I already had pre-trade. Do you understand? If it does something that, okay, this has caught me off guard, then I'm like, okay, I need to reassess. Either I'm on the wrong side of the market here, or I need to close or get out of this trade. And that happens. I mean, we're not perfect. You have to, there's a game of probabilities. Do you understand? So this is, again, why I believe like taking partials is very logical. But for me, I'm looking at, if there's layered liquidity, I can see, okay, well, we've got a high impact news, say, for example, on Wednesday, right? I can see that on a weekly time frame, this is going to come into a logical level, right? It comes Wednesday and I've got a trend line that's built. I love trend lines because as this trend line's building, all the algorithm is basically doing is building market sentiment, isn't it? It's building sell stops that are going to be flooding into the market because people are trying to buy it as it's going higher, creating this really nice trend line, and people are going to put the stops below the trend line. Wednesday comes, we get high impact news, comes into a logical level, takes out buy side liquidity. It's done what it's needed to do. Now, where's it going to go? It's going to attack that trend line. You understand? So even if there's loads of different liquidity pools, I know, right, okay, number one, I'm going to take something off at a logical 50% of that dealing range. And this is where, like, when I say higher time frame and all of this, if you understand what dealing ranges are, that really gives you a huge amount of insight as well. If we're trading inside of this dealing range, then I know that, okay, we're likely to consolidate because we've got high impact news, say FOMC or something like that. NFP is coming out later on in the week. And we're staying inside of Friday's dealing range. Why are we staying inside of Friday's dealing range? Because we're building liquidity. That's all it's doing until we get that news driver that's going to cause that manipulation event. So a lot of the time you're just waiting. You're sitting on your hands. That's easier said than done, especially with somebody who has ADHD. Like
that's what I wanted to ask
it's
next.
Really difficult.
So basically, you were mentioning the higher time frame. You also were mentioning that almost like I feel you execute on the lower time frame based on what you were mentioning. Yeah. So how many trades do you average a week or a month?
It has changed again drastically.
Yeah, that's why.
Drastically. At first, I was trading everything I could see. I was doing maybe 5-10 trades a day, losing most of them. I was just stupid. Again, you'd learn from your mistakes, don't you? So at first, I wasn't journaling. I wasn't collecting data. I'm just very impulsive. I'm trading outside. I had rules, but I didn't follow rules. I just had them there. I wasn't doing really like abiding by them. And over trading, over leveraging, I wasn't calculating anything. And I did this for a while. And I thought to myself, right, if I don't tweak something here or change something, right, it's just, I'm going to be lost here. Exactly. Yeah. What I found was if I started to focus on higher quality setups and I reduced like my trade frequency, that just helped so much more. So now realistically, I'm taking maybe 1, 2, 3 maximum trades a day. And that's been huge for me, right? So I'm filtering out. And again, like I said, when it came to like understanding myself, I understood that I've got about 2 hours worth of focus in these charts. So I want to look at my data that I've collected and say, okay, where's my highest wins, right? And not only that, I'm looking at low resistance liquidity runs, and I mean, they're all other ICT concepts, but I want to see when's the best time for price to do something and move through like the structure with ease, basically, right? That's what essentially a low resistance liquidity run is. But if price is going to be going up and down, I don't want to be in that type of climate, because with me, I know I'm going to get super frustrated. And again, that's self-awareness. I know that I'm going to probably make stupid mistakes if I'm start getting frustrated. So either I close my trade and take a small loss, or I'm at break even, or I sit and wait, right? But what really helped me to narrow down my trade frequency is really focusing on like a 2-hour time frame and seeing everything that I want to see in that 2 hours, right? Before I'd have like, say, that 2-hour window that I'm looking at, but I'm sat there an hour and a half before that time frame opens up. What am I doing sat there an hour and a half when I know I've only got 2 hours worth of concentration span in me? And then after waiting for an hour and a half, now it's in my time window, I'm still not seeing a setup.
Maybe you even put a trade before.
Exactly. Well, this is what I used to do. I used to just, I've seen something, but it's against my rules. Like you have to, it doesn't matter how well you can read price. And in my honest opinion, I think sometimes the better you can read price, the harder it is, because you think that you're Superman all of a sudden. Yeah. You think, I can see price doing that. So I'm going to get in.
On that, is something you mentioned earlier is very important. Yeah. And we have a similar saying in ours, is that there's a difference between understanding and reading price and actually trading it.
Exactly. Massive.
And the saying we have is there's a difference between what we can see and what we trade. So it's actually a very similar line. Yeah. And I think our job as traders is to be as constricted as possible. The more constrictions you have, the better, because you're stacking confluences, you're stacking layers, and these layers are just protection.
Yeah, exactly.
And where, you might say, okay, it looks like it's going to be a buy, but you only have that one confluence there. That's not a trade. It's not a trade. But you could read that, and often you would be right. But there's a difference between that and what you end up trading.
Yeah, exactly.
So when it comes to your and because you mentioned, okay, you have ADHD and you're very impulsive as a person.
Impulsive. That was,
and you're starting taking 10 trades a day. I guess a very important part of your journey was adding as much constraints as possible.
I had to. So I could not trade without it. So for me, number one, it started with understanding like, okay, I keep doing silly mistakes if I'm trading more than 2 hours in the day. So number one, I had to force myself to not open the charts on like at the very earliest was like 15 or 20 minutes before my time window, right? Now, again, that's algorithmic because I understand that there's going to be a macro within this time, so an instruction that's going to be set, like created by the algorithm to do something in price, right? So I'm waiting for that specific time window. But what I was doing prior to that is just trying to read price and order flow like an hour and a half before that window opens up. And what I found, especially when I went back and started actually journaling, like collecting data and actually journaling what I was doing, my thoughts, emotions. And that for me was huge. And I didn't realize how much of a massive impact that would have.
So you have one which is time constraints. What else do you have in your list of major protections?
So, well, obviously I've got like, I call it an A plus checklist, isn't it? So like I'm looking at like, I don't know how complicated I can get with this, but I'm looking at confluences between different markets. I'm looking for SMT divergence. I'm looking for higher time frame order flow. I'm looking at for specific confluence.
What does SMT mean for you?
So SMT divergence is basically...
we refer to that as smart money trap. I don't know if that's the same for you.
He calls it smart money technique. Okay. So basically what it is you're assessing the highs and lows of different correlated asset classes, basically. So say, for example, the dollar index versus euro. Yeah.
Okay.
So they're correlated pairs, right? Well, inversely correlated pairs. So if dollar index is making a higher high, we expect the euro to make a lower low. Mm-hmm. If the euro isn't making a lower low, that's symbolic of institutional sponsorship behind euro. Mm-hmm. And if but you can't just trade off that. That's like one confluence, because a lot of people try to.
Where would you place? Like, I want to go through your hierarchy, but also in most important to you to least important. Whereas timing for us, for example, is very important. Market structure is very important. Take us through that hierarchy.
Right. Okay. So. Again, this has changed a lot over the years, right? What I found was if I start off, right, I'm trying to not use terminology that you guys aren't going to fully understand, because there's a huge amount of terminology with ICT concepts, and just goes through. I'll try and talk to Riz about it, and he's just like, I don't know what you're saying. But essentially, first it starts off with my macro perspective, right? Now, I'm looking at three things really in particular. Number one, for me, it starts with seasonal tendencies. I'm looking at what current season are we in? Are we risk off? Are we risk on? Right? And I start off by looking at the bonds, right? Well, specifically the yields, right? So I'm comparing the 30-year yield, the 10-year yield, and the 5-year yield, and that's giving me a wealth of information. I take that information and I'm looking at what the dollar index is going to do, right? That's going to give us, that can gauge risk on versus risk off.
I know what you're referring to. Yeah. Is this all to basically get a major directional bias?
Yes, this is how much work I do.
So no, I'm more saying, let's say you're a very intra-session and intraday trader.
Yeah.
So you might go through you're pulling a shoestring and you have all of the things along the way, whereas the bonds, it's the yields, it's correlated pairs, and then maybe you might end up looking at the S&P. Yeah. So you've got a whole correlation, and from that assessment, you might determine that, okay, I want to be a bullish bias. Yeah. But that bullish bias is, if you're looking at 10-year bonds,
no. See,
that's going to give you a large higher time frame narrative. But you might be selling for the next 2-3 days. Yeah. So what is your intra-session, intraday protocol?
That's how it's once I establish what I want to do, my highest quality setups are going to be in line with the weekly expansion, right? So this is why I'm looking at the macro, because the higher time frame, that weekly is a high time frame, right? So my highest leverage, my highest probability trades I'm going to do is going to be in line with that weekly expansion, right? So I can trade, say for example, I know that the market's going to go up to go down, right? If we're bearish on the weekly time frame, I can trade that from the going up. I can trade that retracement, but do I want to? Do you understand what I'm saying? So how I do it?
If you're looking on a very high time frame, that retracement could be for 2 weeks.
Yeah, it can do. But specifically, I'm trying to predict that weekly candle, just that weekly expansion. If it's going to go up to go down, I want to be in line with the expansion lower, right? So, but what this does is it allows me to see, right, okay, if the market, say on Monday, Tuesday starts going higher, this is in line with what is likely to happen, right? I can either trade that, and the truth is, over the years, with experience and just with mindset, psychology, and mental capital, I've realized I'd rather wait just wait for my setup now.
Okay, so in your hierarchy of confluence, number one is time.
Yeah.
Number two is trading pro trend.
Well, it's time of day, day of week, week of month.
So what is your priority of time of day and day of week?
So I'm really trading like now because I'm predominantly trading the S&P 500 or the Nasdaq. So my time window is between 9
New York Open.
Well, 9 a.m. till 11 a.m. This is New York time, right?
Yeah.
So I'm looking and monitoring like the equities open at 9:30, and then I'm assessing what the market is likely to do in relation to time and day of week, right? So it's time and
day of week is probably Tuesday to Thursday.
Well, yeah, Tuesday, Wednesday, Thursday. Essentially, what I'm looking for, and I don't know if you guys know what this is, but I'm essentially looking for one shot, one kill, right? I'm looking for a concept that ICT where you're looking for that weekly expansion, right? So when I get in line with one shot, one kill, and essentially my main model that I'm trading is market maker buy or market maker sell models. If I could only choose one that I could trade, and that's the only thing I could do, it would be the second stage of reaccumulation or redistribution. That's essentially the original silver bullet. Yeah. So, and I'm attacking either sell side or buy side liquidity. And if I can see sell side liquidity with an inefficiency below that, it's like gold, isn't it? So
let's continue through the hierarchy. We have timing, so time of day, day of week.
Yep.
Pro trend.
Yeah.
And so we've kind of done the bird's eye view.
Yeah.
Now let's getting into the detail.
So when I get into the details is when I come down to the higher time frame flow. When I've got like the higher time frame, then I come obviously to lower time frames. But when I see, okay, my higher time frame is in line with what I'm looking at my macro model, and then I'm looking at the weekly expansion, and then I'm looking at market narrative. And then when I'm looking at the economic calendar, when all of these things align, the
reason you're looking at economic calendar is because you're aware that it can be a catalyst, and the volatility can come there. But on the flip side, I sometimes feel like there's a lot more volatility or expansion on a London Open. I'm talking predominantly GU.
It can be,
then there might be on a news event. So a lot of times I don't even look at the news because when I'm back testing. I can't really see in price action when the news hits.
Yeah, I understand.
So for me, it's more like an indicator of, yes, there might be a move.
This is why I didn't use it a lot at the beginning. But I found when I started to align my analysis with the economic calendar, it just made a huge difference for me because it made sense.
Is that one of your criteria for execution?
Now
okay, so you have time of day, time of week in line with a news event.
Yep. So I'm looking at news event. London technically is a Judas swing that's going to happen. That's our manipulation phase is usually going to happen in London. And then we're going to get like the move in the opposite direction. And New York's usually going to be a continuation, right? Unless, like I said before, we came into a higher time frame level and we've fulfilled a buy side or sell side objective. And I expect a reversal over here. Then obviously I'm looking at a market structure shift. I'm looking at a fair value gap to be created. I'm looking at an order block. Then I'm looking at
so we don't get off track. Let's continue through the hierarchy. So we've reached now higher time frame narrative pro trend, time of day, time of week, news event.
Then I'm looking at my model.
What are the actual technicals you're looking at?
So it depends on what what market profile I'm in. I have different models for different, I've developed different models for different market profiles, whether I'm in a trending market, whether I'm in consolidation, whether it's reversal. I can now understand what stage of reaccumulation or redistribution we are in relation to the market maker model. And again, these are terminologies that only people who really understand ICT are going to understand. But it didn't make sense. But basically, when I align all of these things together, that's when now you can understand why I'm taking so much fewer trades because I'm way, way more selective than I used to be. All of these criteria have to be in place for me to say right now the likelihood and the probability of this working
that's what I'm trying to get at. What are those criteria on the lower time frames?
Today, we had a euro trade and I've put it on my Twitter, I absolutely nailed the high of it because I understood, especially being here in Dubai and stuff, I knew I was going to get up to trade that session. So I'm looking at everything I've done, my mentorship students will completely understand because when I framed the whole trade based on what was happening between the different assets, right? So when I consider my analysis, I have to look at intermarket analysis. For me, that's huge. It wasn't in the beginning again, which is why I didn't really have any sort of system in place. But now, in order for me to trade the euro, for example, I'm also referring to the bonds. I never used to do that, but I'm allowing to gauge market fluctuation based on all these different assets. So when I'm looking at my model entry, I'm looking at, I need the algorithm to tip its hand. Essentially, this is what interbank traders are trained to do. They understand the underpinnings of the algorithm, and when they see the algorithmic footprints in price, is what Michael refers it to, they know when they're going to get in and out, right? So, I mean, the 2022 model, for example, is a very, very easy basic model. Once you understand, and the truth is, most people are not going to be able to make a lot of money with that because they're not going to understand, like I just said, the higher time frame narrative. They're just trading a pattern.
I'm interested to understand the actual execution points. So you've constrained yourself from higher time frame, you've constrained yourself on time, and so forth. But what are because there's so many variations. You could have a limit on a supply zone. You could have a run of liquidity and then a break of structure. You could have there's so many variations on order block, on a fair value gap, on a break of block.
Anything I can see, it doesn't matter.
So because now you have an abundance of bullets. Which ones are the ones worth it for you?
I get this question a lot. And only really, I think experienced IC traders are going to understand when I say this, whatever I can see in the chart. There's not going to be every PD array at any one time.
So you're actually not a model-based, you're confluence-based. On the day, what makes sense to you?
It's confluence-based, but based on what I can now see. Essentially, and one of my friends who's another chartered student said this, and he said it perfectly, and it made a lot of sense. The highest form of ICT trading is being able to read algorithmic order flow. Because you're not confined then to any one model or, I can see a fair value gap or I can see a breaker or I can see...
No, of course. But,
so when I come to...
You don't want to be running parallel with I understand how the algorithm moves, but it's not a full understanding.
Yeah.
You've got indications of confluences that show you, are you in line with it or not? But there will be certain situations where you have 10 confluences on your side, therefore you should take the trade. Yeah. But on this occasion you only have 1 or 2. It might be algorithmic probability, but you can't just jump on a trade with 2 confluences.
I can.
So, okay.
This is my point I'm saying to you. When you get to a stage...
How can you determine
because when I get
what
to
is not random or what is likelihood of outcome?
You get to a graduation where you start understanding that, okay, like say for example, and again, you're not going to understand if you don't know what the 2022 model looks like, but I think for the audience who do understand ICT concepts, when I say the 2022 model, they absolutely understand what I'm referring to. They're looking for a run on liquidity, looking for a market structure shift. They're looking for a fair value gap, basically, that qualifies a structure shift. And again, there's going to be loads of different nuances in terms of wicks to bodies and different data points within the arrays and what IPTA is basically going to index within these data points and stuff. And that's a huge graduation. That's why it's taken me a long time.
I'm a bit confused then, because you have the algorithm will not be random.
No, it's not.
Especially the one that is on a central bank level. Yeah. They have a specific criteria on how they would deliver price. So if that is the assumption we are making, when it comes to actually individually executing a trade, there has to be therefore equally strict criteria that you have to follow. Because one day you can take halfway of the imbalance, the next day full imbalance, the next day you're going for the wick, the next day you're going for a run of liquidity.
But
then if you're going case by case...
No, this is what I'm saying. I can tell when it's going to rebalance an inefficiency fully. I can tell when it's going to have institutional order flow entry drill. I can tell on the way the bodies of the candles and how high that goes into a graded fair value gap. You see, I also grade my fair value gaps, which is, again, I'm trying to keep it simple for people to understand, but the levels this goes to is nuts. I've even taken it further than what ICT is taught in charter level. So I know, and I know it sounds arrogant, and I don't, for me to say okay, one day I'm going to just do a fair value gap, or one day I'm going to key off a breaker, or one day I'm going to key off an order block. Essentially, I'm looking at the range between where I can logically place my stop and where the algorithm, like I said to you before, is not likely to go. If I can see a balanced price range, and I can see
if you are allowing yourself to say I have 50 confluence types and the various gradings and so forth, and I can understand all of them, it sounds like whenever you have a confluence that hits, you will be able to take a trade. That's fine, but then the likelihood is every single moment in the market there will be a confluence.
Which
there
is
for
why
you.
I'm
so
looking
how
at
do you
a
stop
specific time window.
Okay,
that's
so
where it
any
comes down
confluence
to.
within a time window.
Yeah, because
is your execution.
It's time before price. In fact, you can trade off just time. It's time before price. Timing is the key element of all of this. And again, that was a graduation to that because I wasn't looking at time very heavily. understanding that the data points that are going to become active, what the algorithm is going to index, is going to be within a window of time. So when that time window opens, I know that there's going to be a specific macro that is going to run, and based on market structure, based on liquidity pools, based on the arrays that are present in price, in structure at that specific time, is going to determine where I'm going to get my entry in. And again, that has to come down to...
I want to get deep into this because I know I'm following everything you're saying so far. And this is challenges we face too. Let's say you have... I'm going to run from our frame and you can kind of bounce off that. So right now, we'll say, let's say bearish market.
Yeah.
So I have a bearish market on H1.
Yeah, okay.
And Asia is printed. Asia's given a consolidation. And right below my supply zone. So right now I have resting liquidity and a supply zone right above.
I'm not familiar with supply zones and stuff because I never...
Supply and market structure. Just a market from a market structure perspective. So I know that if I have resting liquidity over here, during Frankfurt Open, I can imagine price started to come up a bit and maybe give a small high.
Right, yeah.
And then it starts to shoot down. Now, what is that telling a lot of people? That's telling people, okay, we've taken Asia high liquidity. It's come to the supply area but not tapped into the preferred zone. That's going to entice a lot of people to jump in. You know, the people that are overzealous, they're like, okay, the market's reversing, whatever, and that's going to create that FOMO. So what does it do? It gives you that reaction and then it'll shoot up for London Open. So now already a bit of liquidity is taken. What's taken? The overzealous traders and also Asia high. And then it comes into that supply zone. Now some people might say, okay, you just jump into that supply zone and execute the trade. This is what I want to get at. So that's something I would not do because that supply zone might be 15 pips or 20 pips.
We can measure how long that's going to be.
You could either say I take a limit.
We already know what the Judah swing is going to be.
No, follow my thought. So you could either say I enter on a limit on the supply zone and just take the order block of the supply zone on M15. The M15 zone might be 20 pips. That's one option. Another option is I see a M1 engulfing, I market execute. Another one be you have an EMA cross, I execute. Another one could be let it do a fair value gap and then execute. Another one could be internal BOS and then execute. So you have so many options and I'm in the same position or we're in the same position where we can say likelihood is going to sell from here because we've got market structure alignment, we've taken liquidity and we've got London Open. These are three major pillars and then I can execute the trade. But a lot of days I'll allow it to pass because, for example, a criteria we have in our entry models is we need that internal BOS. And the reason we have that is from your perspective might be, okay, well, you missed an opportunity. From our perspective is you could have taken 20 options on that sell.
It comes down to, again...
if it doesn't fit your requirement, be happy with leaving it.
It comes down to personal individual and how you want to build your model. I can comfortably take the absolute nail the high on a turtle soup if I want to because Asia in the central bank dealers range is already going to tell me deviations and how high or how low the algorithm is going to run liquidity. And then there's a standard grading structure of 10, 20, 30 pips.
So how would you know on one day that you want to enter on the imbalance fair value gap close on a supply zone? Whereas other days, you allow price to come in, it gives a small reaction on the supply zone, then wicks out the supply zone for 2 pips and then reverses. So if you're playing the supply zone, you're going to take a loss for 2 pips. This is where,
like when I say supply and demand, and I don't, that goes over my head because when I'm looking at specific raise in price, we don't have zones. It's a specific level in price and that we can determine how high or how low that level is supposed to go in price. What we are assessing really is the data points, what the algorithm is going to index. And when these confluences, deviations in pricing structure, which we already know before 12 a.m. New York time anyway, right? So we're looking at, this is a logical level. This is an inefficiency where there's an order block sat there and it's also sat about 30 pips, so let's say 20 pips above the Asian high, and it's also 3 standard deviations of that Asian range or the central bank dealers range. And that's going to give us, like, that's all these confluences aligning, but there may not be a fair value gap there. I may look there and I say, okay, that's the mean threshold of an order block, right? That may be the consequent encroachment of a fair value gap. That may be 50% or 75% of a graded swing on the previous swing. I'm looking at where I am in relation to the dealing range with all, like, I have different charts that have different grades on it. And I'm looking at, I'm constantly measuring, I'm measuring this swing, I'm measuring this swing. I'm looking at this intermediate term high, this short term high. And I'm looking at the relationship that's when that Judah swing happens in London. I'm looking at what the dollar index is doing. I'm looking at what the bonds are doing in relation to the dollar index. And if I'm not even trading euro or GU and I'm trading, say, the S&P 500, that's going to give me a huge amount of insight to say, okay, this is the likely level it's going to be. When I say technical science, it's technical science. There's no ambiguity in this.
That side I'm in complete agreement with. You have your protocol to arrive to a zone that's saying it's a likely zone. There's many ways of arriving at. You have your way, we have our ways. That's that's not in contention. But then it's imperative you also have an execution criteria, because every day if you're just coming to likely zones, they're exactly that. They're just likely, and you cannot add. Maybe you have a probabilistic edge in that zone.
Yeah. So
do you not have an execution criteria?
Yeah. So okay, there's different. Again, when I say there's the models. Different models. So again, number one, I'm looking at what there is in price and looking at confluences between standard deviations, grades, like PD arrays, of what I can see currently in market structure. If I want to be really aggressive, I can take the turtle soup high when it comes into a confluence with a higher time frame array at a specific time, above, say, a number of pips above a previous high. And I can take that. It's not a problem. But that's like the highest, like, sort of...
high risk one.
It's high, exactly. That's the high risk one. Why do I need to do that? Do you understand? Like I used to do that, and to be fair, I could do it, and I still sometimes do. I just put a small position in, like maybe 0.25% of the risk I'm going to take. But then what I'm waiting for is that displacement in price lower as we break market structure. We leave a fair value gap.
Okay, so
in that fair value, So in that fair value gap, I'm looking for other things. There's not always going to be a breaker. There's going to be a balanced price. So there's going to be a balanced price range. But then again, I'm grading that. But not only am I grading that fair value gap in relation to, say, I'm trading euro or I'm trading the pound or something. I'm also looking at how high is, say, for example, the dollar index moving into its fair value gap. I'm assessing where the volume is in the bodies of the candle to say, okay, we're likely to completely close. But if we're in a balanced price range and the market's moving quickly and we have had a big displacement, we might not get back to that fair value gap, but there's a breaker there. Do you understand? That breaker also has a confluence with deviations in price with another higher time frame level. So I'm constantly assessing all the different dynamics of how the market fluctuations are happening at the same time.
Okay,
I just expect something in price to happen, but then when I can see it, I have models that can get me in, but it has to be within what I can currently see. If there isn't a breaker in there, how can I trade my breaker model? Do you understand? So there has to be something that I can see, but it's got to be logical and it's measurable. So this is why ICT has such an ego, because he can do it better than anybody on earth. It's insane. He can get it to the actual level. When I seen him doing this live day in and day out, you get to a point where you're like, I need to know how to do this, which is why 5 years of my life I dedicated harder learning this than I did my own degree, because I realized that in my degree, I've got a ceiling for my earning potential. If I can get this right, and I don't care if it takes me 5 or 10 years, my work ethic and how I can like throw myself at this, even if it took me 10 years to do it, I was going to learn to do it because it was like wizardry. Do you understand? Like nobody should be able to call the market turning points to the pip, and he did this day in and day out. We have thousands and thousands and thousands of people around the world who witness this now, even on YouTube, on live on a daily basis. How can you now turn around and say, yeah, it's a fraud? This guy had his hand in creating this algorithm. I'm absolutely convinced with it.
Who do you think calls him a fraud?
There's a lot of people who call him a fraud because they either have their own courses that they want to sell, and ICT is just killing everything right now. And I think there's people who just genuinely don't like his personality. He can be very, very polarizing. Personally, I think he does it because he likes to create a fire, and he's a brilliant marketer, and he's a very good businessman. So I don't know if you know, it's
a story. So a few years ago, we got into a bit of a thing. It wasn't really a thing because we understood very quickly it's his character. He enjoys that little bit of drama, let's call it. But it was actually, he had a public display of what he was saying back and forth, and we were saying back and forth. But in private, he'd be texting us.
I didn't know it was you, at the time. I remember
it was actually our partner Wally that was more leading it. But it was behind the scenes. He'd be texting Wally and be like, it's all love. Don't worry, I'm just saying this. And we'll be back, no problem. And he was actually giving us advice. He was like, you guys are young, keep it up, whatever. But publicly, he was like, I'm going to destroy you, whatever.
He does that. He admitted this to us. He says, look, I create a fire. He says, this is how I market.
So actually our one was more like, he put out a public challenge of like, anybody want to step up to a challenge, a trading challenge. And no one was stepping up. So it was like, no one stepped up. This was my deadline. No one stepped up. I didn't know too much about him, but then everybody tagged us like, hey, you guys should step up.
But also the reason of this is because he said, who steps out with $1 million on the table? So he's a very smart guy.
Yeah.
90% of people on social media will not put €1 million on the table with him.
So if people tagged us, we were like, okay, let's step up.
I'm interested in. I want to see him in the Robbins Cup. Do you know what I mean?
So the Robbins Cup is it was something where we felt a bit. I've never heard of the Robbins Cup. So we kind of said, we'll deposit the amount into a broker. IC Markets is one of the biggest brokers in the world. We have no hand in it. We don't own it. We don't manipulate it. So we're like, okay, we deposited it. We sent a screenshot, and it was like, the ball's in your court. And he was like, no, it has to be only in Robbins. I didn't know what it was. I don't know if he has a hand in it. So then we were like, let's not do Robbins. Let's just pick a broker of your choice that is not owned by anyone, that cannot be questioned. And I think that's where communication fell apart.
I think it's one day I think he's going to do it, and I think he's waiting for the challenge. And when he does...
it's also from our side maturity of like, back then we were like, let's get into this battle, whatever. But now I'm looking back, I was like,
it doesn't matter what it is. Do you know what it is?
It's childish, actually.
It is, exactly.
If we were to step up,
100%.
what is it to prove? Is it to prove we're cooler than you? Is it to prove we're better than you?
Especially with the likes of social media, everybody goes out and, they're measuring dicks, aren't they, really?
But the reality is now, this is 3 years later or something, I have a lot of respect for ICT, and he might even be a better trader than me. I have no ego or arrogance to that. He might as well be. It's not my concern to prove who's better than the other. It's more that he's doing great things. I can respect that, and a lot of people see we're doing great things. If we get our equal credit, not above, not less, then I think there's no reason for anyone to be like, we're a clash.
I think that there's a problem with the trading community is like we're all in the same boat. We're all like, all of us, we could have gone the easy direction and got a 9 to 5, but we don't. So we all have this thing about us where we want to excel, we want to strive for excellence, want to like break that norm. So I think people, if they sort of understood that we all have this same pursuit, rather than, saying who's the best or trying to knock each other, we should be encouraging and supporting each other because we're all after the same thing, essentially, aren't we? So I think social media for me, like I dislike it. I stay away from social media. I don't even know how I got so many followers on Twitter. I'm not even joking. Like I tweet once a day, and
that's fairly consistent.
I don't even.
That's how you got it.
I don't read my tweets. Do you know what I mean? I don't read my comments in half the time, and my DMs are just like a nightmare because it's.
So to end on, what is your? Because you're quite prominent in the industry, specifically in the ICT niche. Yep. I'd only recently come across you through Riz, but when I saw your profile, okay, people know about you, people talk about you. What is your goals moving forward for not just yourself, but like for the industry? Or where would you like the industry to go? Or what would you be happy to see?
What I want to do is being like one of Michael's charters and stuff, and one of the few of them who does have his own mentorship, his own academy and stuff like that. I want to help, like, number one, help with his legacy move forward and teach like the younger generation that are going to come into trading. But I want to teach them like the right way. And I want to break away from this notion of like this buying and selling pressure and stuff that dictates the market. Like the markets were going to be like left to the likes of buying and selling pressure by retail when absolutely every single thing else in the world is controlled by algorithms and people behind the scenes. This wasn't random. It was never going to be random. The markets don't move randomly at all. And I can prove it. We can prove it in ICT concepts because it's measurable. Every single thing in it is measurable. So moving away from this idea of like, oh, there's buying and selling pressure and that's how the markets move and it's random and it's too big to be manipulated. We need to scrap that. ICT's came and he's fucked the game up with that. So it's now time to say, right, let's put our egos aside. Let's put Michael's personality aside because, yes, he is polarizing. And that's why a lot of people give him like a lot of stick and why they say he's a fraud. Partly his fault because when a lot of the people who say it were his old chartered students who basically, if I'm just going to say it bluntly, they were too lazy to really learn it properly because it was a lot of information. And because they spent 2-3 months trying to do it, it didn't work for them. They said, oh, he's a fraud. Right now, you've got thousands of his old students who are like smashing it. They're making a lot of money and stuff. And there's people now who are learning for free, coming out with like statements and coming out with like funded, like getting ridiculous amount of money funded. Right. So separate the money element for a second and separate Michael for a second. And let's just concentrate on the fact that, okay, this algorithm, that there has to be an algorithm that books these markets. How can we now utilize that as retail traders going forward? That's what I really want to now do, is how do we utilize understanding that, okay, if their markets are controlled by an algorithm, how can we now use that to our advantage? Because ICT's opened up the gates for us, right? We're never going to be able to beat the banks. And there's still going to be people who are going to struggle to make money in this industry because I said, like, even understanding how the algorithm works is probably 40% of the battle, isn't it? Like, it's still psychology, mindset, risk management, all that stuff plays a heavy part in making money. But now we can finally, after all these years and myself going through every different school of thought, we can now understand, okay, let's put our differences to one side and understand there is an algorithm. How do we use this? Instead of fighting who's better at a strategy and, it's stupid.
Does ICT allow their charter people to teach or is...
He said to us, he didn't. He first said, like, you can't teach. So for years, nobody taught anything. Like we had an NDA with him. And then he started to teach basically back for free on YouTube. And he said to his private students, he says, listen, guys, I'm giving you like the green light. You can use my name, do your own mentorships and do your own thing. Only then did I start saying, okay, cool. And the reason, and I wasn't even supposed to teach, that's another whole story, but by chance I ended up in the position that I was in. But a lot of it was the amount of questions that I was getting with misinformation and people doing like crazy things. I thought I need to make something for people who are going to at least, okay, if you're going to learn from somebody other than Michael because you can't stand like how much he rants or how long-winded his stuff is, then okay, I'm the next guy who's a chartered student who's privately mentored by Michael. I'll give you the platform to springboard you to understanding ICT concepts, but I will still always say, learn from the source. I'll help speed up your journey because I've been through it myself. I've done many years into this. And okay, I take out all his waffle and what will take maybe an hour and a half, an hour for him to do, I condense that down in 20 minutes. And essentially I run the same format that he was doing in his mentorship with us, which is the real lessons, is understanding how price is going to move and why. That's market narrative. Understanding, like, people are like trying to trade ICT, but all they're looking at is a pattern, and they're trading a pattern. But without the narrative behind you, the pattern's just a pattern. You may as well trade bull bear flags or whatever it is. Do you understand? So the narrative and sitting with me now on a weekly basis, I'm dictating where the market is likely to go. And today, like, we had an absolute beast of a trade on euro, but that was outlined all the way from the bonds and why euro is supposed to drop and why it's likely to drop and the levels it's going to go at. And I got it to pinpoint. And I mean, my students who have gone through the mentorship, they'll vouch for that. I don't make it up. I'm doing it and I'm showing it real time before it's happening. This is why it's going to happen. And then when it happens, there's no surprise anymore. That's the power of understanding how these algorithm works. When you're looking at any other school of thought, you understand that my system says, okay, it is going to do this, but why? There has to be the narrative. And this is what ICT and understanding algorithmic order flow. So I'm not saying, and there's a lot of people who work and who are ICT students who are purist, ICT purists, and they bash everything else, right? They piss me off, to be honest with you, because you don't need to know ICT to make money, right? But if we can at least understand and recognize that there's an algorithm, we can use that to our advantage no matter what school of thought is. So instead of like us fighting each other, we should all just get together and say, okay, well, I can take this specific part of the algorithm and adapt it to my own strategy. It'll work. Whether you want to use an EMA crossover inside of a fair value gap, for example.
It works.
Very exactly.
No, so that's kind of one of the intentions behind the podcast, is that we became very close with Riz after doing episodes with him. And, you know, going out with him, going for dinners and stuff, we became very close. And I've always given him props, publicly, privately, that, bro, he's doing a very cool thing in the industry of bringing people together, as you said.
And I think it's needed.
Everyone's thought about it, everyone's wanted to do it, but no one's really taken steps to do it. Now, Riz has taken that first step, and a lot of people are now collaborating. The reason we're sitting here together is because of Riz. Other traders I've met was because of Riz. And, you know, it's gonna continue. So we wanted to, through Riz's encouragement, he was like, guys, you need to start a podcast.
Exactly. I was
like, okay, you know, let's give it a shot.
Rooting for you guys as well.
So, I mean, let's see. But I think these kind of conversations, the things Riz is doing, things yourself are doing,
they need to
it's gonna lead to a better industry for everyone.
I think we just need.
I think that's what we should.
We just need to take the toxicity out of this community, because like I said, we're all pursuing the same thing. Do you understand? Stop measuring each other up and let's just try to help each other.
Cheers to that. Okay, well, I think we're close. Hitting the 1 hour and a half mark. So thank you for coming on. It was actually a very deep conversation.
Thank you, man.
Thank you very much.
I hope I didn't go off too far. Is it understandable enough? Because that can happen with me.
I'm sure we'll stay in touch.
Inshallah, definitely.
We'll keep exchanging chart work and
man.
as a group keep refining.
No, it's just amazing to meet both of you, man. So like, I'm honored for you guys to have me here. You know.
Thank you for coming.
Thank you very much for your time.
Cheers.